Welcome to PIB's webinar on optional remuneration arrangements. My name is Sean Healy and I am a tax principal here at EO. Their national team of experts can help with all aspects of the benefit strategy, including consultancy, implementation and communication, as well as ongoing maintenance and regular reviews. Today is on optional remuneration arrangements, or as it is often referred to. We have decided now to go through this presentation and take some questions. We will finish within the hour. Listening in using your computer speaker system. If you were to join over the phone, just click the Info tab and use the dial-in information provided. Yours have all been muted. There has been a growth in the use of salary sacrifice arrangements to secure both a tax and NIC advantage. Periodically, HMRC have introduced measures to close down arrangements which the Exchequer has viewed as abusive. However, there remains a perception that there was an ongoing and increasing cost of salary sacrifice to the Exchequer. In addition to this, HMRC were concerned that there was no longer a level playing field between those employers who used salary sacrifice arrangements and those who did not. As new OPRA legislation was introduced from 6 April 2017, with the immediate imposition of transitional regulations. For the 2018 tax year, benefit reporting purposes, these traditional rules are making life pretty complicated for a number of employers in terms of compliance and also in terms of how these measures should be communicated to their employees. And it's now perfectly possible employees sitting next to each other and receiving the same benefit may be taxed on different amounts. To help them to understand and address these issues, internal procedures, and help them to work with their benefits platform providers, ensure that the implications are communicated in a clear and comprehensive way to their employees. I'm delighted to advise that our specialist speakers today are Steve Albert and Jill Brookfield from BDO and Paul Nelson from PIB. Steve is a specialist human capital director in our Leeds office and he leads BDO's approach to OPRA. He's an associate director in our London human capital team who has a particular interest in this area. And I'm very pleased to be able to introduce Paul Nelson from PRV as our third speaker. Paul is consultant and head of business development at PIB. Today we cover both traditional rules and the new rules. We'll detail at some of the fundamental issues the new legislation throws up for employers and walk some specific examples bring some of the practical issues our clients are facing to the fore, both tax and an employee benefits perspective. Finally, our general observations, recommendations and next steps for you to take away and consider part of your strategy to manage the impact of OPRA on your business. You can, during the webinar, please use the Q&A feature which is in the right-hand corner of your screen. We'll look at as many of these questions as we can at the end of the webinar. If time does permit, we will respond afterwards. We are in the webinar and we'll email you a link to the reading in a few days' time along with the slides. The email will also include a link to a survey asking you for your comments on this webinar. Please do as we can use this feedback to improve our output going forwards. As I said, we will finish within the hour. So, over to Jill.
Thank you and good morning everyone. I'm going to start by looking at the background to the changes in legislation. As shown, there's been a significant growth in the use of salary sacrifice arrangements. In the days, probably 15 to 20 years ago, they were primarily used to achieve NIC savings on pension contributions. But over the years, they've been used far more widely to take advantage of tax and NIC savings across a broad range of benefits, from chair to bikes provided under cycle to work arrangements, parking, and a whole suite of insurance and other benefits provided under flexible benefits arrangements. Increasingly concerned over the cost to the Exchequer of the tax and NIC savings, has previously taken steps to prevent salary sacrifice being used for certain benefits. Historically, this included, for example, the Home Computing Initiative, and recently workplace canteen arrangements and subsistence expenses. HMRC are concerned that there isn't a level playing field, Some employers are using salary sacrifice to reduce the cost of providing benefits to their employees and increase the take-home pay for employees, with the cost being met by the wider tax-paying population. So for the consultation process, we now have the new optional remuneration legislation. So where presented into prior to the 6th of April 2017, there are additional rules, and we'll look at those in a little more detail later. From 2017, the new legislation applies, and it is quite wide-ranging. We now have the concept of Type A and Type B arrangements. Benefits are under offer if they are provided via either type of arrangement. Type B is where the employee gives up the right or future right to receive earnings in return for a benefit, and to your traditional salary sacrifice type arrangements. Arrangements are defined as arrangements which don't fall within Type A, and the employee agrees to be provided with a benefit rather than earnings. So there are scenarios where an employee may have a choice between a cash allowance and benefits. For example, choosing between a company car or a car allowance, or possible benefits arrangements with a cash flex pot. Deliberately been widely drawn to stop employers moving from Type A to Type B arrangements. It's complex, and because it is new, guidance is quite limited, and things are very much still evolving at this stage. Phrases which are relevant for the new OPRA legislation, and here is used these throughout our presentation. We discussed the Type A and Type B arrangements. Of course, under OPRA, the new legislation creates a charge to tax and Class A national insurance contributions on thereof the amount of pay given up by the employee, taxable value of the benefit in kind. In getting the taxable amount, we need to consider the cash equivalent. The normal rules, the value of a benefit to be charged to tax is called the cash equivalent. We've also the concept of modified cash equivalent. As you'll see in our examples later, in some instances under OPRA, we have to calculate a modified cash equivalent to arrive at the taxable amount. This is for items such as cars and living accommodation. Is the amount given up by the employee for the benefit, and the rent amount is the amount treated as taxable earnings from the employment, and this is generally the higher of the cash equivalent, modified as necessary, and the amount forgone. As I mentioned, visions. If rents were entered into before the 6th of April 2017, they're not immediately affected by the new rules. The normal benefit valuation rules will continue until the earlier of any renewal of the arrangements or any variation or modification of the terms. And the 6th of April 2018 for most benefits, 6th of April 2021 for cars with CO2 emissions above 75 grams, living accommodation and school fees. You have an annual renewal date for your flexible benefits scheme of the 1st of January. Benefits will be covered by the transitional provisions and taxed under the old rules for the period of 31st December 2017 and all under the new rules from the 1st of January 2018. There are exceptions, and arrangements will not be considered to be varied for the purposes of the transitional rules if the variation is for a reason beyond the control of the employee and the employer. For example, if someone has a car which is written off due to an accident and that car is replaced, new legislation will not apply immediately to the replacement car. The variation is also disregarded if it arises in connection with entitlement to statutory benefits such as statutory sick pay, statutory maternity pay. The trust can make life complicated, not only for reporting purposes, but as Sean mentioned, you may well have two employees sitting next to each other with the same benefits being taxed differently. For new renewals during 2017-18, there are key issues you should be thinking about in terms of application of the OPRA rules. As the legislation is widely drawn, HMRC have clearly thought it true to make sure it captures all scenarios under Type A and Type B arrangements. There are some exemptions and exclusions to the rules. Benefit optional remuneration arrangements are not covered by existing exemptions from tax, unless the exemption is what's described as either a special case exemption or excluded exemption. Tax exemptions already have specific rules within the tax legislation which prevent a tax exemption from applying where the benefit is provided under salary sacrifice. For example, this includes things such as subsidised canteen meals. If a case exemption applies, then the new OPRA rules do not apply. Benefits are not affected by the new rules, and benefits can still be provided under salary sacrifice with the appropriate tax and/or NIC advantages. This includes, for example, pension contributions. I won't dwell. It covers the legislative provisions, and it lists the various special case exemptions and excluded exemptions. So the key excluded exemptions include pension contributions, cycles, childcare vouchers. If cover is provided by a salary sacrifice, then the exemption will continue to apply generally if contributions in respect of death benefits are made under a registered pension scheme. Sacrifice has been increasingly used in the provision of benefits, and we've listed here some of the more common benefits that we see being provided. More benefits are caught under OPRA. It is necessary to consider if OPRA applies, and this probably demonstrates some of the complexities and the need to think quite broadly about the type of arrangements you might have in place. It isn't to stress that this is just for guidance. In column, we've listed items which are outside the scope of OPRA. If you're currently providing pensions, childcare vouchers or bikes under salary sacrifice, then now might be a good time to consider introducing these. The middle includes items which are generally caught, but there are exceptions. And if you have benefits in this column, then it is important to consider the specifics of your arrangements to consider, for example, whether the transitional rules apply and how long, and the implications of allowing employees to trade up or down for income protection benefits, etc. The items which are definitely caught if they're provided under OPRA. If you have benefits in this column, then you definitely need to take action as soon as possible to make sure you fully understand the implications of the new legislation. Transition, and as we draw to the end of the tax year, there are a number of considerations we envisage being relevant for employers. You will have employees receiving the same benefits but being taxed differently because of the impact of the new rules. This could be because one employee has entered into a salary sacrifice arrangement and the other has not. Perhaps employees at certain grades who are provided with benefits at no cost, and other employees who are able to select the same benefit by a salary sacrifice under a flexible benefits programme. Employees who were in a salary sacrifice arrangement before April 2017, then they might be being taxed differently on benefits from new joiners who've commenced employment since April 2017. One car scheme might be at the end of their contract now, a new car being taxed under OPRA, but another employee might have the same car with a couple of years still to run on the existing contract, so that will be taxed under the old rules. We haven't already entered into communications with employees which clearly explain the consequences of the new OPRA legislation. Now's the time to start thinking about this before P11Ds are prepared. In the administration issues to consider, not least making sure that you have appropriate system processes in place to make sure that you're in a position to identify when the new rules apply and calculate the reportable amount. It may be that there is a lack of clarity or guidance on exactly how the legislation applies to some benefits, in which case it's appropriate to engage with HMRC. Now to hand over to Steve.
I'm just going to go through some examples on OPRA. As you can see from the previous slides, OPRA covers more than just cars and pensions, but I am going to cover three of the most common benefits under OPRA. So the first one is private medical. So as an example, you have, as a business, you have individual private medical coverage provided to employees free of charge with no alternative. The employer offers some senior employees additional cover for family members at no cost, or they can take a cash equivalent of £750 if they do not wish to keep the family cover. So in this example, the cost to the company of the individual cover is £250 per employee. The cost of family cover is £1,000. This current tax year, one senior employee chooses to receive the £750 cash allowance, another chooses the family cover, so it will be taxed. Look at rules, you have to go through what the cash equivalent and the amount foregone is. So the equivalent of the benefit of the family cover is £1,000. The amount that they give up is £750. The cash equivalent in this example is higher than the amount foregone, so this will be the amount that is treated as earnings on the 11D. So if he's choosing the family cover, then the amount will be the £1,000. This is a type of the opera. For employees choosing to take the £750 cash allowance, however, you'll the standard cover of £250 reportable on P11D, subject to Class 1A, and the £750 cash allowance will be through the payroll and subject to pay as you earn and Class 1 NIC. The next on company cars. The example we've got here is you have a new joiner who starts in May 17, and that is to ignore the transitional rules. They take a company car from the 1st of June under the flex scheme. The salary sacrifice per month is £650. Because they want a higher specification car, they all make a capital contribution of £2,000 towards the car. The car has a list price of £35,000 and a CO2 percentage of 18%. The cost to the employer was £650 per month, but this is split between £5 for the actual lease of the car, £80 for the maintenance package, and £70 for the insurance. For P purposes, the relevant amount is the higher of the cash foregone and the modified cash equivalent. Now, in this example, we've got the breakdown of the actual lease cost. You may not always have that. And I'll tell you what you do when you don't have the breakdown later in the slides. So, if you example, you looked at the cash equivalent of the slides, you get the list price, less capital contribution, times by the 18% CO2 emission, and then apportion it for the days available. However, under opera, you've got to look at what the modified cash equivalent is. So the modified cash equivalent ignores the capital contribution. So you take the list price, you multiply it by the CO2 emissions percentage, and then you portion it for the days available, which gives in this example £5,350. You then compare this under opera to the amount foregone in the tax year, and the amount foregone in the tax year is £5,000. Although the employee gives up £650 in exchange for the car, you ignore the ancillary benefits, i.e. the insurance and the maintenance, and you just look at the amount of the lease that is in relation to the provision of the car. So the amount foregone is the £500 a month, 10 months, £5,000. This is where you do your comparison for opera. Modified cash equivalent is therefore higher than the amount foregone, so this is the relevant amount that you will use on P11D. Once you get to this point, however, you then make an adjustment for the capital contribution. So the amount for P11D purposes is the modified cash equivalent less the capital contribution at the appropriate rate. The amount you enter on P11D would be 4990. Complicated example. But there's things to consider when you look at company provision as well. So Jill mentioned the transitional rules for existing contracts. You'll have people put under the transitional rules. Also covered what happens when there's a variation. You might have variations throughout the year which you don't have to apply the new rules. You might have variations where you do have to apply the new rules. If you buy low emission cars, 175 grams of CO2 or less, to an employee via an optional remuneration arrangement, they'll still benefit from the traditional rules. However, cars over 75 grams from April will be caught by the new rules. Private use payments. Well, if salary sacrifice for a private use payment, you ignore it as a private use payment, but you have to factor it in when you're doing the higher of consideration. If private use payments from net pay, so a traditional payment for private use, you then ignore that for the optional remuneration consideration, but like capital contribution, you deduct it once you've worked out the higher of. Now, clearly, you know, you have to make sure that it's a qualifying payment for private use before you're eligible to treat it as such. What if you've got any classic cars and there's a capital contribution? Well, classic cars, you ignore the capital contribution. What happens? You can't identify the cost of the connect benefits within the lease. So what happens if your lease provider tells you it's just £650 a month and there is no split? Well, HMRC have said, and what the legislation tells you, is that you take a just and reasonable apportionment. And what clients are doing is they're going to HMRC to try and agree what just and reasonable apportionment would be. What happens when you trade up and trade down cars? You look at the contributions which we looked at. Private fuel affected. Well, fuel affected. Well, it's very rare that you ever see a salary sacrifice for private fuel or fuel. So if there was an option to salary sacrifice for fuel, it'd be caught under the rules as well. The next is group income protection, because this again highlights how complicated these rules are. So, payment made by an employer to provide an employee with the right to receive sickness or disability payments and excluded from tax. And bear in mind the use of the word normally. This is a complex area. On the that the contract is between the employer and the third party. Where such benefits are provided under OPRA, the exclusion does not apply. The value of the benefit is then the greater of the cost providing the benefit and the amount of salary foregone. So in full, they cover all the permutations on this one. So you've got a group income protection plan which is provided to all employees for 50% of their salary and no cost to the employee. And it cannot flex down to reduce the benefit below 50% salary. The 50% basic level of cover is an excluded benefit. Scheme, employees increase their cover to 70%. This employee £100 per calendar month. I'm sure you'll all agree it's a very expensive group income protection plan. The additional cost to the employer for increasing the cost to 70% is additional £75 per month. So if you've traded up, you have to consider the OPRA rules. So cash equivalent will be £900. The amount foregone is £1,200. So OPRA, the foregone is greater than cash equivalent, so this will be the relevant amount, and this will be the amount treated as an instance. So £1,200 will be reported on P11D and subject to Class 1A. However, in a different example, group income protection plan, the core cover provided to all employees is now 60% at no cost to the employee. But the flex scheme, you can trade down to 40 or 50% of salary and receive a cash allowance. So this is now a type B OPRA. Amount is the higher of the amount foregone and the cash equivalent. So the cost of the employer of the actual level of group income protection provided and the amount of cash allowance that would have been received if the cover of 40% had been selected. Your level of cover is no longer exempt under OPRA if there is an option to flex down. Go back up. Go back. Back. One more. I missed a slide out there. Sorry. So, as you can tell, group income protection, if you've got 3 different outcomes depending on what you've got. So, what we learned very quickly about OPRA in those 3 examples, we've learned that OPRA is very complicated, and if you've got one benefit, you can have multiple treatments depending on the detail. What you need to, have you had any variations throughout this year? Have you had any new joiners promoted during the year where the benefit package has changed? OPRA is not just a once a year consideration. This should be consideration throughout the year based on the actual benefits you provide and the circumstances of your employees. Most flex schemes will renew either on the 1st of January, such as ours, or April. So if you had an a flexible benefit package that renewed on the 1st of January, you're going to have part of the year covered by the transitional rules and the remainder within Opera. How difficult is that going to make your P11Ds this year? We've already made different benefits have different tax treatments, so you really need to look at the detail of what you have. And one of the things we've realised and seen a lot of clients have is when you start looking at Opera, there are other issues that come out of the woodwork. So we have an example where we looked at a specific benefit. That benefit could mean exempt under Opera, but because of change in how the company had operated it, meant there was an actual tax issue and a disclosure to HMRC. Is a flex platform, will your system be to support the required calculations? Your payroll benefits, are you actually payrolling the correct amount, and have you been doing that throughout the year? Think of employees for a minute. I've confused most people in the last 10-15 minutes, so when your employees see their P11Ds, are they going to understand this? Are they going to understand why theirs might be different to the person sat next to them? You need to think of how you communicate this to employees. Let the benefit provider be able to provide all of the relevant information to you, i.e. a detailed breakdown, or your amount deduct from employees come over as one sum. If you use P11D software currently, will it actually cope with Opera, or will you have to do manual calculations? If benefits not covered today, how are you going to treat them? Because there are quirks that are seen in a lot of other benefits. So to take away, optional remuneration is difficult and there's a lot of consideration to be had. So you need to undertake a review of what arrangements you actually have in place. And don't think about the ones that you publicise to staff. Think about where someone, maybe in HR, agrees that someone can have something instead of taking cash. So you've got to take a car, can they take a cash allowance? I agree in something that's outside of your normal rules. What renewal and the timing process? So when did your benefits renew? When did you have a change? When does Opera kick in for you? And how difficult will your P11D process be? Arrangements. This is probably one of the most key points that I would say, because the devil is always in the detail in these discussions we've been having with clients. We've looked at sort of IT equipment, and in there was a potential for a double charge because of how poorly worded the contracts were. Your organisation is responsible for this. I'm sure after listening to this, you hope it's not you. Employees aware of this, will they understand it, and are you going to communicate this to them? And what impact does this have on your overall benefits package? Remember, if there is a choice of benefit or cash, then there is a risk, and you need to consider the optional remuneration rules. However, not all doom and gloom, because if you haven't considered the arrangements which are outside of optional remuneration, such as pension, childcare and cycle to work, if you don't have them, now is the best time to get them in. HMRC have confirmed they're okay to be provided under an optional remuneration arrangement.
Well, thank you, Steve. What I think could be useful now is going to take a step back and look at some of those implications that Steve and Jill have kind of gone through in quite a lot of detail. What should and hopefully does kind of bring to the fore here is how technically complicated this subject is. The need to review your benefits, to look at a number of items here, review the benefits themselves in line with what you've just heard, review your technology platform. Technology platforms, if you're running a flex benefit scheme, are likely to be where you do run that scheme, so you need to review the capabilities, functionality and so forth of that. As Steve's come up with, again, the P&D implications of that need to be looked at. Very importantly is your communications. You have to look at what actually is happening to the tax, national insurance and indeed what employees are actually understanding as a result of these arrangements. So just taking a quick step back, I know it's been looked at already, but looking at where we are today, for most of you who run flex schemes or have any salary sacrifice arrangements in place, they are well into the transitional rules, the grandfathering rules that were set up in April that actually now end as of next month. And that will mean if you've been through any variation in that last 12 months, so a variation is a new joiner, a variation could be a renewal, a variation can even be a lifestyle event. You need to look at those situations. What we're seeing out there is not many employers have actually grasped this and actually looked at a full-scale review to get everything lined up in accordance with the rules. So if you think about that, only past April, where the mainstream rules come into place, there'll be a number of employees there that are going to have additional P11D tax or certainly some form of additional tax to pay, and the employer itself is going to have additional NIC to pay on those benefits, depending on how they're caught and exactly the nature of that. So the importance of reviewing now, if you haven't already done so, is key, and that review is going to take into account a number of different lines. We'll look at some of those as we sort of go through the sort of summary points. So having said that, what actually are we seeing in the market, as it were? So looking at what we're seeing, we are fairly active in the employee technology platform space. Many of our people come from large-scale employee benefit consultants and are very experienced in this technology. We ourselves are independent of the market, so we speak to a number of the technology providers. So a lot of our sort of understanding is not just our own, but clearly comes from the technology people. And there's quite a lot of if you like, understandings and things that are probably being missed. So it's a very large company that we're sort of aware of, thinking it's all about cars and mileage. That might be a misconception. Some employees are ceasing salary sacrifice on everything that isn't excluded, which is probably a sort of baby in bathwater. Some are reviewing all benefits themselves that are excluded, so literally just staying with the salary sacrifice side. Cash alternatives, you heard technical issues that arise where there is a cash alternative in lieu of a benefit or used to purchase a benefit. It's a very complicated issue and needs to be looked at, but again, many employers are missing that. A big one is probably assuming that all of the existing benefits technology and effectively have everything in place. This is such a technical field, it may be beyond the scope of most employee benefit consultancy other than the very specialist niche. It goes into accountancy and tax and probably legal in a strong way, but that joint approach or having that joint level of review is not as common as it would need to be in this particular degree of change. And then we're seeing some employers who are effectively doing nothing, literally haven't actually realised that. And it's coming to the fore even today with some large companies we are dealing with. We see that they haven't even addressed yet or are unaware of these issues coming through. So hopefully, obviously, all of you will have had something in the review sense and gone through that, but be aware there is a number out there that have yet to pick this up, and there will be tax and NI implications as a result of that, and that will be communicated rapidly, or at least understood rapidly and communicated. Have you got any other thoughts on what employees are seeing out there?
Yeah, a lot of employees, some of the issues that they're facing is around where they've got a specific benefit that they're currently providing and it was always fine under salary sacrifice, but the detail within the contracts lead to not only be caught by Opera, but you can then have a double charge. So with IT, we had someone provide laptops, and it was a year policy, and the sacrifice under the new rules would be you get £100 a pay for £1,000 for a £1,200 iPad. But the terms and conditions of the scheme were that it transferred on the final day of the 12 months. So at the higher of calculation initially under Opera, being 100 versus 1200, at the end of the tax year you then had a transfer of an asset that is passed over. They deemed it as gifting the asset. Double taxation. We've seen other companies whereby they looked at certain benefits, the one I mentioned earlier, where they looked at they looked at having accommodation provided under a salary sacrifice, and then realised that someone internally had some property and it wasn't a qualifying salary sacrifice anyway, and nor had they put up P11D. So they ended up with a disclosure to do. So finding that the companies are thinking around OPRA, they're finding other issues that aren't linked to whether it's OPRA or not.
Yeah. So that point about making sure you really do review benefits in depth clearly is quite crucial here. You need to look probably wider than just sort of thinking of them as simple, exclusions, what's not excluded, etc. You could look at things, as has already been mentioned, which of those benefits that are OPRA excluded. You could obviously continue with those or add more to that. But the kind of area, and the one that's causing most of the confusion, particularly in the employee benefit space, is what were previously and are currently viewed as benefit-in-kind benefits. Those are the target of the OPRA rules in the main, or they go far wider. They're the ones that most employers may have use of, and they're the ones that effectively will now be going straight into a taxable situation for the employee and the employer with paying NI. In terms of the review, you might want to have a look at what you've got in terms of the excluded box or what you'd like to add, what previously benefit in kind, and they still are, but would be caught by OPRA, so this would include things like income protection that's been mentioned, health screening, car park, and so on. Besides, some of these benefits, you may wish to say the problem arises through choice. So you have got an income protection scheme where you've got the ability to flex up, long and hard about actually, if you offer that as a core benefit with no option to flex up, it doesn't get caught by OPRA. Other benefits, you might want to move into a net pay environment or use a discount portal or find some other way to provide. But there are a variety of different ways of looking at how you can review your benefits. If you're also drilling down into that, you probably want to consider your overall benefit strategy. So if you're taking a wholesale review, because you are going to need to communicate what the findings are, you're going to need to look at your survey, take feedback from employees, possibly focus groups, look at your engagement stats. If considering benefits that you offer choice on and they could be dealt with better, well, how much engagement is there? Are they being used by a vast majority of employees? If so, should they move to the core? And vice versa. If there's very little take-up, then does it really matter if you use salary sacrifice or go for a voluntary? So this kind of framework actually can help guide a lot of the benefit review. What we're doing with a number of our clients is taking the opportunity to remove duplication. Many benefits, particularly in the health and risk side, carry lots of additional add-on benefits that kind of mean employers can have lots of duplication and therefore some cost. We'll look to remove that. Introduce some ways of creating pathways through the benefits for health and risk interventions and solutions, which is a kind of triage service. So a number of add-on things you can do whilst you're in this mix of looking at the benefits review. And then clearly you have to review the communications. Very surprising if you haven't reviewed the benefits or the technology yet, that you don't have a communication need now coming up, which will be employers are facing a higher P11D tax charge. So communications are probably going to have to go. The question is, do you just look at risk mitigation, or do you also look at trying to engage through a review of the benefits and bringing that out as well? So review benefits is quite key. And then another part of this is looking at your technology. If you use a flex benefit platform, many of these platforms are perfectly good at hosting and communicating benefits, but some of the underlying technology in some cases can be last sort of 10 years ago when it was first created and viewed. In terms of OPRA, it will not, in most cases, be able to cope with an OPRA-type situation. OPRA is complicated, it's technical, and it's going to be beyond the scope of most employee benefits platform technologies we speak today. If you do want to make additional reporting or start to feed in, you're going to need some hard coding done on your platform. You're going to need embedded rules changing. There will be some quite in-depth need to change. So you need to look at your platform and see, is it still fit for purpose in whatever way you've reviewed your benefits? If you're looking at OPRA, it's likely to be outside scope for many of the technology providers and indeed the advisors working with them. It just is, as heard. It's extremely technically complicated, so you're going to need to take advice on that front. P11D reporting, most of these systems don't really get involved with, or certainly with P11D reporting. What a platform does it will host the benefit, communicate the implications of taking that choice or that benefit to your employee. An employee will decide to take that choice and select that benefit. That will then trigger two files in sort of set, one that goes to payroll to say, please deduct X from net or gross pay, and one that will go off to the provider, giving them all of the background about that person joining the scheme. There is anything in that that goes back into payroll and says, this is going to be caught by P11D, this is going to be treated in this way. You're going to need to think long and hard about how you deal with that particular information and build systems or understanding on top, so you capture what needs to be done. So you do review your technology, and that needs to be done obviously in tandem with the benefits themselves. And something that comes up a fair amount is sacrifice agreements. Can be a generic document that covers all benefits. In today's world, that probably isn't going to be sufficient. You need to have different salary sacrifice agreements for childcare, for bikes for work, for pensions, etc. And if you have got one generic document, that will need to be looked at. So looking at technology is key, and then sort of in kind of summary, that just feeds into the sort of key points. In that, knowing you have got communications to issue, knowing you probably have got some tax changes that need to be communicated and picked up, you're going to need to review benefits I've mentioned, look at impacts on P11D, and maybe as a result consider payrolling benefits if you are going to increase the P11D your benefits as a result of your review. Look at your benefits platform, look at the technology, is it fit for purpose? And when you're looking at the communications, which will clearly go hand in hand, it's just risk management. There's a lot to be gained here by actually engaging in a more positive way and actually using this as a stepping stone to a more modern or a more improved benefit range. So those are the sort of key points, and I'll pass back over to Sean.
Everybody, that was really informative, and I'm sure that this will have given people an awful lot to think about. Just update on some admin points. We will be sending all the slides out to you on email. There will be the commentary of our dulcet tones accompanying the slides, and if you've got any questions to pick up that haven't already been put in, please do so now. So before I move on to some general observations, as I've just said, if you still do have questions for our panellists that you haven't already submitted, do send them in the Q&A feature, which is in the right-hand corner of your screen. For me, there are some key messages which have come out of today's session, perhaps the important of which is that the old legislation is not as straightforward as it may first appear. There are steps which I think any employer needs to take, including to pause and on the 2017-18 reporting requirements to ensure what's called the relevant amount has been clearly identified and calculated. Both finance and HR need to work in partnership to full compliance. Consider remuneration packages available going forward, and on how these changes are being communicated to your employees. Are you minimizing the value of the total reward available, as well as clearly explaining the tax implications? Communication is key. There are questions that we are having clients to consider. Start looking at some questions now, and we've got quite a number to get through. Some for Paul first. So, we've got an employer that uses an online benefits provider, and some of those benefits are configured on the site. How do you deal with the position of these benefits?
Well, the answer is you can't. So a lot of the systems will have been pre-configured a number of years ago, and there may be patchworks and workarounds that have gone on top in late years, but in essence, you almost need to go back to basics, put every single benefit, look at the underlying process that your technology provider adds to that, and take a look at that in the round and decide what's best to do. But you cannot, unfortunately, rely on your technology provider to be accurate for this one.
Okay, another question that we've had is, and this is not quite regularly now, an employer set up an expected group-like policy and that allows people to opt for higher cover under salary sacrifice. It's better to use what's called a registered life policy, and some employees suffering a lifetime allowance charge?
This probably needs a bit of thinking, and it depends on the specifics, but accepted group life policy is obviously outside the lifetime allowance in terms of the proceeds. So the key is to weigh up what's the profile people that are flexing up or choosing to increase their premiums into an accepted life scheme, because those that do will obviously now suffer a tax charge and be hit on the employer side for national insurance. So the key thing is clearly that charge compared to a lifetime allowance charge, you would probably err on the side of paying the tax and protect yourself away from the lifetime allowance. So that might be your one way of looking at it. But a broader view might easily be, well, if that's the case and you've got a lot of people in accepted life increasing, why not look to offer it as core for that group and remove the problem straight away?
So clear there that the individual fact pattern is going to govern the right advice, but detailed pensions and tax advice is necessary.
Yes.
In those circumstances. One final question for you before we expand that and give Jill and Steve a chance to show us their knowledge. How are employers communicating the tax implications to employees in your view?
I think when we sort of open it up, some of it is not widespread, so there's not a huge amount of communication that we are seeing. Clearly there are people who have taken reviews and have put things in place, but the communication in general hasn't yet been done in a wide-scale sense, and there's probably quite a lot of latent need to start looking at that as we speak, as we walk into the end of the transition rules. So most employers, I expect, if they haven't already done so, are probably in a position now where they're not fully aware of the implications and need to look at that first and design communications from there.
And Steve, here's a quick question. Perhaps I'll put this one to Jill first. We've got the workplace nurseries still remain the best option. If it's on, are they unaffected by the change? What do you think about that?
Well, childcare, employer-provided childcare, all forms of childcare are included excluded exemptions and therefore fall outside of OPRA. So really, there's nothing on the OPRA regulations that's changing that position.
Okay, thank you. I'll go through these because we are getting quite a lot of questions through. One for you, if I may. We've got an attendee asking how employee ownership schemes, ECOS as they're commonly called, impacted by OPRA.
Good question. And basically, under employee car ownership scheme, there is no benefit in kind. It's basically where there's generally cash given to an employee and then when go to an approved provider to obtain a car. So as there is no sacrifice, there's no option to take cash or a benefit in kind, I would consider those to be caught under OPRA.
Okay. The car question. The car question seems to be quite popular. Would you say what we call net private payments, so private payments for use of car that are made out of net pay, deducted from the cash equivalent, and if that's a higher value?
If you're looking at a proper private use contribution that meets the requirements of the legislation for a private use contribution, you still do the higher of in the car calculation to get to the modified cash equivalent. You then deduct the payments for private use once you've done the higher of.
I think it's key there to also say that we all use these terms, private use, but all of us would be careful to check exactly what's going on there, because there's a fine definition in the legislation of what a private use contribution actually is.
Absolutely.
That's going to qualify for tax relief. Bill, one for you. Would OPRA affect holiday purchase where people are choosing to buy additional holiday, which is available in a lot of flex schemes?
That's a good question, and one that HMRC have quite clearly stated that additional holiday, changing working hours, flexing working hours, etc., is not caught within OPRA at all. So that's clearly outside the scope of this legislation.
Okay. Another leave here on private medical insurance, PMI. You have somebody who's setting up getting additional PMI and offered family cover, but they only want single cover, for example, for whatever personal reason. Is it okay, this participant asks, just report on the value of the single cover on the P11D as normal?
So where I have family cover or I can have basic cover, but but I don't get any
Well,
cash.
your offer of family cover,
Yeah.
there's no cash alternative, I think the participant's asking, but for personal reasons, you just want silver single cover.
Then I would say that would be outside the scope of OPRA, because for OPRA to apply, there has to be a benefit and an amount of earnings. So what you've there is you've got a benefit versus a benefit. So consider that to be a type A or a type B.
That question perhaps just illustrates where HR and finance have got to really talk carefully together about what the relevant term is being used and what the reference points are, because I can see that giving different answers depending who you ask in the same organisation. Again, one for you, Steve, here on a similar basis. If, say, a senior member of staff who's offered a car or the option of a car allowance, and that's agreed before an employment contract is offered, so at the negotiation stage. Once that has been agreed and been arranged, can it be changed? And if so, is that outside the scope of OPRA?
HRC have really thought about these rules, and one thing that they say in the legislation is that if it is provided under optional remuneration, so the type A or B, regardless of whether those arrangements are made before or after the person's employment begins. So therefore, if prior to joining an employment, I have the option to take cash v car, that is an OPRA, and I would have to consider the rules.
Thank you. Another question on holidays that I'll go back to Jill on. Somebody's asking whether buying holidays are exempt, but then, which we've said is correct. But what about if an employer has the ability to sell holiday days back to their employer and effectively increase their cash pay on that basis?
Yeah, HMRC have confirmed that selling holidays and getting cash, there's benefit. It's just effectively changing working hours, if you like. So both buying and selling holidays are outside the scope of OPRA, even where there is typically cash payment when people give up holiday to get extra payment.
So we're all agreed then, effectively, holidays are outside
the scope of OPRA. Obviously, the cash that is received for selling holidays is just taxable as normal through the payroll, subject to pay-as-you-earn tax and national insurance contributions. Okay,
we've got a couple of questions here about P&Ds. I think Steve, Jill and I will all perhaps have a little debate on. The first one is, will the 11D form be adopted to capture instances where an alternative value needs to be taxed for benefit in kind calculation purposes? Steve, do you want to come in on that?
The working sheets have been adapted to basically go through the higher of where they're provided under OPRA. So the working sheets have been adapted, but then obviously when you do the higher of, you get to the relevant amount, and it's the relevant amount that will then go to the P11D. So the 11Ds per se probably won't change, it's the worksheets behind them.
And similarly, another participant's asking whether P11D reporting works, how the P11D reporting works for a car that's provided under the new OPRA regulations. P11D reporting is not going to particularly change, and I think, we're certainly aware that the Revenue are still working very carefully on how to present the relevant information on forms P11D, and that's causing them some consternation. So it may be a little bit of time yet before we're able to comment fully on that. One question for you, Steve, on salary sacrifice regarding to pensions. Particularly is asking whether if they make bonus payments, that they have bonus payments that can only be added to the pension pot through salary sacrifice. Does that fall within OPRA?
So again, because it's a contribution to a pension, would be one of the excluded exemptions, so it would fall outside the scope of OPRA. But one thing to be very careful with any form of bonus sacrifice is make sure that any entitled to the bonus hasn't already triggered pay-as-you-earn from being applied to it. So you have to make sure that you give it up before the pay-as-you-earn point becomes due, and it should be okay to be provided under OPRA going forward.
I agree with that. It's a key point that all of the changes are probably an opportunity to refresh your basic understanding of salary sacrifice and to ensure the tax points are dealt with correctly.
Quite often it'll be a director that wants to sacrifice a bonus into a pension, and looking at when pay-as-you-earn is due is a bit more complicated for those.
It is. Wrap up with one final question now, back to company cars, which are proving pretty popular, and no great surprise on that. And a participant is asking if they no longer offer a company car and a cash alternative to employers a choice, are they safe from the regulations, shall we say? Have also taken a policy to actually make amendments to contracts. So I think to encapsulate that, what the participant is asking is if they currently have a car cash scheme and they take that option away, will Opera impact that?
I think it depends on the provider going forward. So historically you had the transitional rules to work under, and where you stop providing cars under choice today, provide going forward. If you provide a company car with no cash alternative, then you're just under the normal car rules. If you're providing cash but no car alternative, then you're caught under the normal pay-as-you-earn rules. So it all really depends on what things to whether it's under Opera.
I'm going to sneak in one final question for Jill. Participant's asking, what else needs to be shown for a season ticket? And it's possibly being suggested that this might not be on P11D at the moment.
Okay, probably need to make a couple of assumptions here. Obviously, quite a lot of employers offer season ticket loans on an interest-free basis to MBs. As long as they're less than £10,000, then that is when there would be no requirement to benefit in kind. So the employee has a loan of up to £10,000 for a season ticket. That doesn't trigger a benefit in kind. Beyond that, I can't see that there will be any further adjustments under Opera.
HMRC use the examples on loans whereby an individual forgoes salary in exchange for paying the interest. Basically what happens there is you are still taxed on the higher of the pay given up and the 11D benefit of the interest. So you can avoid having an 11D benefit by saying you'll give up gross pay for the interest.
And I think that's a key point, and also just quickly there on what the difference between what the ticket costs the employer and what cash has been asked to be given. Most employers will do that on a cash neutral basis, but that's just worth bringing together. Well, we promised to finish within the hour, and I'm going to wrap up questions for now. If there's any we haven't picked, we will have a look at those and send them out. Of course, with some answers along with the slides, which I said you can get on email. So that brings us to the end of our webinar. I'd like to thank Paul Nelson, Steve Alban and Jill Brookfield for your insights today. If you have any further questions after today, please do ask us. And once you leave today's webinar, you'll receive a survey asking you for your feedback. If you can spare the time, please do so, as it helps us to ensure we are providing the content you want. As I said, you will all receive a follow-up email in the next couple of days, a link to the recording for today's webinar. So we're going to wrap up now and say thank you very much for listening in, and goodbye.